Hi everyone, please take note of the following disclaimer. Please note that this video is for informational, educational, and entertainment purposes. It does not constitute financial advice. We are not registered financial advisors. Hey everyone, welcome back to another episode in the DIY investing education. And today we're going to talk a little bit about a scary word in investing, leverage, or sometimes it's known as margin, right? Taking margin. So what is financial leverage, or what is leverage vis-a-vis investing? Well, I was looking for a term and I landed on Investopedia's website here. I think that this definition is fairly accurate. Financial leverage is the practice of borrowing money, investing the funds, and planning for future returns to be greater than the debt servicing costs, right? So think of it kind of like a mortgage, right? If you have a mortgage, well, guess what? You are borrowing money. That is considered leverage, right? You're leveraging your house to borrow the money and you're paying interest on it depending on interest costs, right? Which is different for everyone, which depends on the interest rate, of course, because you're basically putting a bet that your house will go up in value over time, right? So it's a similar concept. Now, I'm not going to really talk about doing it yourself, like borrowing money with your broker yourself here, although you could do that, and that's a whole other ball game. I really want to focus on ETFs that have leverage already included inside of them, right? Or leveraged ETFs. So there is really, in my personal opinion here, I don't think it's a matter of opinion, but I'm just going to say generally speaking, there's really two types of leveraged ETFs, if you will. And we're going to focus as usual on the Canadian stock market, and we're going to use some examples here. I'm really going to show you the two different types of leverage because it's very important. The first type of leverage is really what I like to call modest or light leverage, designed for long-term buy and hold investors. This is my opinion. So let's look at a few examples. Why do I say this? Well, let's look at a few examples here. So you have the Global X S&P 500 Index ETF, right? USSX. S&P 500, basically, no leverage whatsoever. They have a Global X Enhanced S&P 500 Index ETF. So really the same index. The stock symbol, just change that X to an L and you get the enhanced version. This one uses 25% leverage. So if you look at the description here, you see that through the application of light leverage, USSL provides 125% exposure to the performance of the S&P 500. So a couple of key things. Number one is to understand how much leverage, right? So 125%, it's basically 1.25x magnification, right? You're getting 25% more magnification up or down. So the leverage amount is very light. It's very modest. It's not like it's double or triple. It's 25%. So technically, you have 25% more risk, 25% more volatility, if you will. It's actually 25% more volatility. Risk is, a term that's in the eye of the beholder, but we could say you have 25. Let's just say, for general sake here, for this example, it's kind of like you have 25% more risk, more volatility versus just holding the S&P 500 by itself. What does that mean? That means there's an amplification up or down with your return or your performance. So for example, if both of these funds have been out for over a year, so if you look at the performance of USSX, you click on performance and distribution, you see that, for example, the 1 year return is 14.41%, right? That's 1 year. You see this is as of November 30th, 2025. Very important to understand the date. So if we look at the 1 year performance of the leverage version, you see that it's slightly higher. It's 16.87. So that's where this 25% amplification takes place. Now, one very important point, it's not going to be exactly 25% higher or lower because remember, there are leverage costs or borrowing costs. And this brings me to a very important point. This is actually Global X Canada here is borrowing the money. This is all happening within the fund. So they are borrowing, and this is cash leverage. It's regular cash leverage, right? It's nothing fancy using options and swaps. They're just borrowing the money 25% and to amplify. So you see that price that return performance. Of course, this is in a positive 1 year, right? It's a positive return, so it's amplified positively. It's very important to understand that if we have a bad year, for example, let's say it's minus 14.41%, well, the performance of USSL, which is amplified, is going to be probably about approximately, it's not an exact science, minus 16.87%. Again, I'm just an approximate to give you an understanding of how it works, because leverage works both ways, right? Up or down. So very important to understand a couple of things here. Number one, this is a small amount of leverage. It's a light or modest amount of leverage. When I say small, I mean that in my opinion, but like it says here, light leverage, 25%. So it's really 1.25x exposure or amplification, up or down. Another thing to understand is that this leverage, it's not you borrowing the money technically, it's Global X borrowing, or the ETF borrowing it on your behalf, if you will. It's integrated in the ETF itself, so you don't have to worry about things like margin calls or anything like that. And another thing to remember is Global X Canada is a really big financial institution in Canada. I believe they're managing approximately over 30, I think almost 40 billion, if not, they passed 40 billion in AUM and assets. So they could get much better borrowing costs than me and you can, right? If we would borrow the money ourselves, we don't own $40 billion worth of stuff. So they get a good rate, a better rate, if you will. Not good, a better rate than me and you can. You guys are trying to understand my point, right? Another thing to remember is, where do you see the cost of the leverage? Well, the leverage cost will show up in the MER. So if you look at the MER of just the regular Global X S&P 500 index fund, you see the MER is 0.09%, a very typical S&P 500 MER in Canada. For the S&P 500, for an S&P 500 index fund. If we look at the MER for USSL, the leverage version, you'll see that it is a lot higher. That's because the MER does include the borrowing cost or the leverage cost of this ETF. But again, remember that the performance, which we just saw, is after, or is net of the MER. Right, so this is net of the MER. This is after the MER or the fee, all the fees are taken. So another example, if you want to look at the Global X S&P 500 covered call ETF, you have the unleveraged version here, USCC. If we look at, for example, the performance of 1 year, it's 12.02, so it's positive. So like you'll probably guess, the leverage version, the 25% leverage version, USCL, again, you'll see that here, 125%, right? It's 25%. Leverage is going to be slightly higher, 13.51. So again, it's not going to be exactly 25% higher, because there's leverage costs, there's borrowing costs as well. And again, if we look at the MER, you notice that it's going to be much higher than the non-leveraged one, because it includes the borrowing cost. So this is really the first type of leverage ETF you need to be aware of. My personal opinion here, this type of leverage, modest 25% leverage, and Global X has a lot of lightly leveraged 25% ETFs. They typically have enhanced in the title. Typically, you'll have the non-leverage version and then a leverage version. These are really designed, my opinion here, for a long-term buy and hold investor who wants a little bit of leverage, some amplification, who doesn't want to deal with borrowing the money themselves, and is okay with a higher risk, right? A higher volatility. You're getting 25% higher volatility. But the advantages are many, including over the long term, potential amplified returns over the long term, no hassle, right? And of course, these institutions have most likely will get much better borrowing costs than me and you can. Now, the second type of leverage, this is where it's much, much higher amplification. So Global X Canada has a line of ETFs called the Beta Pro ETFs. And these ones are very, very highly leveraged, or much higher than 25%. Sometimes it's 3x, 2x, or 3x. That's, not 1.25x. A 2x would be 2x, right? It would be 200% leverage, not 1.25. It would be 2, and of course 3 would be 3x, right? So like it says here, this suite of ETFs is designed for Canadians seeking daily, short-term, tactical trading vehicles that are comfortable managing investments with higher risk potential. So these types of 2x, 3x, daily reset products, leverage products, they're typically designed for short-term traders, right? So it's a lot more leverage. And let's go through a few examples. For example, they have QQU, which is the NASDAQ 100 2X Daily Bull ETF here. So this essentially, one very important thing is that for this kind of leverage, it's typically not cash leverage. They typically use options and swaps and different things to get you that amplification. It's much more, obviously. So for example, if we're looking at the NASDAQ today, the NASDAQ's actually having a pretty bad day today. I'm filming this on the 17th. It's down about 1.68%. So the QQQU, which has double the amplification, right, 100% amplification or 2x, you'll see that it's down 2.84%. So it's down much more. This is the 2x Daily Bull ETF, which means that this is a bet that the NASDAQ 100 is going up. You're a bull, right? But they also have Daily Bull 3x. This has even more leverage, right? And you could see that it's down even more today at minus 4.14%. And then sometimes you might see that they have a bear version, a daily bear version like this one, which is basically you're betting that the NASDAQ, you're going to invest in this one or get this one if you're betting that the NASDAQ 100 is going down. And it is going down today. That's why you see that this one is actually up 2.83%. So the bear ones kind of do the opposite, right? If the market's up, the bear ones are going to go down. If the market is down like today, or the NASDAQ is down like today, the bear ETFs are going to go up. So these ones, very important to understand that it's a lot more leverage in the first set or the first type of leverage ETFs that we saw. And the important thing to remember is that, like we saw at the beginning here, the introduction, or their homepage here of the Beta Pro, these are really designed for short-term trading, right? In my opinion, they're designed for traders or swing traders. You're making a one-day or short-term bet on something, and you could get 2x or 3x amplification. Whereas something like a USSL, which is a leveraged S&P 500 index fund, is only 1.25x amplification, 25% leverage. A lot lower, really designed for buy and hold long-term investors. And also the leverage is different. They're using pure, just regular cash borrowing. So hopefully this video was informative for you and you understand the concept of leverage ETFs. I think, in my opinion, the two most important things to remember is, number one, there's really two types of leverage ETFs on the Canadian market. You have ones like we just saw, USSL, USCL, really designed for long-term buy and hold investors. In my opinion, you're getting a little bit of amplification, basically 25% amplification. Remember that the MERs are going to be higher on these because the leverage costs are included in the MERs. But as we saw from the performance, if that asset has done well in that period of time, the leverage version, lightly leveraged version, is going to do a little bit better. Not exactly 25% because you have to take into account the borrowing costs. But if we look at the performance, remember that these performance numbers are net of borrowing costs, or net of the fees. And then there's another set, which is really the really more high risk ones. Those would be the daily reset 2x or 3x bear or bull ones. For example, the Beta Pro suite from Global X Canada, but these are really designed for traders. These are not designed for long-term buy and hold investors, in my opinion. They're designed for Canadians who are seeking, like it says here, it's perfectly written, daily short-term tactical trading vehicles. All right, so give me a thumbs up. I would really appreciate it. Now you should understand how leveraged ETFs work. If you have any questions, let me know in the comments section. And a big thank you to Global X Canada for sponsoring this video and this educational series. See you next time.